Joining me to discuss this are Anil Ghelani, Senior Vice President at DSP BLACKROCK Investment Managers, as well as Kaustubh Belapurkar, Director of Fund Research at Morningstar. Thank you, gentlemen, so much for joining in. Great to have you in the studios.
Likewise.
It's a very interesting and a slightly touchy topic as well, as I think you know, the Indian investor is entering the next leg of maturity. So I want to start by getting your opening thoughts, Kaustubh, because, you know, I've heard a lot of numbers get thrown around, including that, you know, large cap funds are simply not able to deliver that kind of performance. So why not look at ETFs or index funds? Your initial thoughts.
Sure. So let me just kind of demystify, you know, what the thought is, right? So if you tend to look at performance in a short term, yes, it is possible that, you know, over a 1 year perspective that large cap funds, a large part of them can underperform, but clearly when an investor is coming in, he's looking in for a longer term, 5, 7, 10 years. And when we look at the track record of the Indian mutual fund industry, we've seen at least about 50 to 60% of large cap funds, the well-managed funds, continuing to beat the benchmark, albeit I would say that the alpha has been shrinking, but there is still a certain amount of alpha to be made in these funds.
Okay, well, let's open up with some thoughts, Anil, from your side as well. I mean, passive investing, it's still very nascent in India. I mean, the numbers, I think the kind of money that passive funds are managing compared to active funds, it just pales in comparison even now, right?
Well, I think the way to look at it is that today mutual fund industry itself is yet very nascent and a lot of penetration to be done. Within that context, if you look at passive funds can be split into two parts. One is index funds and ETFs. Today, both index fund and ETF put together is roughly about 89,000 crores in comparison to about 22 lakh crores of the total mutual fund industry. How we see this is that going forward, there is definitely going to be a trend where passive investing will definitely take up. Mutual funds, as I said, as we increase the penetration for that, passive investing or passive mutual funds can be a simple tool to further enhance and fast track that type of penetration. So to put it in context, let's say today there is a small investor recently started working, drawing a small salary. Can we not reach out to them and say, okay, start investing while you think through and pick up some good portfolios or some good funds, or your advisor suggests some good funds to you. Meantime, at least start investing through some passive investment for products.
You know, let me actually take one step back here for the viewers who would be wondering what we're discussing. What is this active? What is this passive? So just a simple explanation. Passive funds are not managed by an active fund manager like actively managed funds, as the name suggests. Passive funds simply track an index, an underlying index. It could be the NIFTY 50, it could be the BSE 100, any of the indices that are widely available. And they simply mirror the stock composition, at times also completely mirrors the underlying index. But having said that, just to clarify this point, the passive fund need not exactly be a mirror replica, right? As in the case of DSP BLACKROCK, because you recently came out with an equal weight index, which is not strictly NIFTY 50 in the strict sense of the word and the definition, right?
Yeah.
So do explain this concept to us.
Sure. As such, within passive investing, one type of product would be mirroring readily available plain vanilla benchmark like a NIFTY or Sensex, as you mentioned. There is another component which is called, as we in slightly fancy word, smart beta, or if you put it in very simple context, is a combination of active and passive, but then managed in the form of an indexed approach, where we come up with a slightly differentiated way of generating an index, and then we track that index on an ongoing basis. So, for example, if you look at simple basic principles of investing into any portfolio would be that, typically speaking, one would like to buy stocks which are leader in their own segments of market or in their sectors. So let's say NIFTY 50 would meet such requirement that typically they are all the blue chip names across the respective sectors. But second basic principle of investing is that your portfolio should be well diversified across stocks and sectors. Now NIFTY 50 typically does not meet that because it's slightly heavily skewed towards a particular sector, let's say financials, or a few large names like HDFC Twins are like about 8-9% each in the benchmark. So it's putting higher level of reliance on 2, 3, 4 stocks and 1 or 2 sectors. So what we try to do is we try to equal weight all those stocks so as to give a different risk and return outcome, where each stock is 2% and 50 stocks, so that builds up my 100% of my portfolio. Or in simple terms, let's say if you are playing cricket and everybody, retail investors can relate to it.
So
instead
all
of
the
relying
batsmen
on
are going to contribute an equal number
equally,
of runs.
yeah, and
Got
not
it.
just batsmen, not just batsmen, but even all the fielders, all the bowlers. Each run saved in fielding is 1 run scored. So the context is, rather than relying on 1 or 2, that this is my star batsman. Let's say my star batsman is out on a marriage holiday, and my best bowler is a spinner, but today he's injured his finger, so not able to perform his magic.
Yeah.
Now what do I do as a captain of the team? I will make sure all the players are put in equal limelight, that you also perform, stop each and every run.
Absolutely. So there you go. You have one example of one particular type of a passive investment product. But I want to sort of, take a step back and talk about the difference, fundamental difference between ETFs and index funds. Kaustubh, explain this to us. And from an investment standpoint, which product sounds better?
Sure. So the fundamental difference, and like Anil was talking, is obviously both of them track a certain index, and that's a commonality there. But the platform is slightly different. So you have a exchange-traded fund, which typically you would buy and sell over the exchange, unless you have a certain lot size that you can directly contact the asset manager to buy it. Whereas a mutual fund, works on a typical buy and redemption, purchase and redemption cycle, like any other actively managed fund, which is the index fund. The other thing about an ETF is, since it's an exchange traded product, you can potentially kind of buy it intraday, and you could get, the value movement as per the price within that day, rather than the end of day net asset value for the fund. So the mutual fund, you will obviously have to, now the mechanisms where you can go and buy them online, but the traditional route has always been sort of physical pen and paper. I think that's changing with, the BSE Star MF and a few other platforms that are coming up, which are great. But over the exchange, you can ETF, you can just go, if you have a Demat account, go and buy that over the screen or a trading portal that you have.
Anil, your thoughts on the same thing? We're not talking about cost just yet,
Yeah.
but just about the simplicity for a retail investor in terms of, approaching the product, understanding it, liquidity, redeeming, getting your money back. Just compare these two, index funds and ETFs for us.
So I'll take the first point first in my initial response about the convenience and ease. I think from that perspective, no doubt, index fund could be much more easy for a retail investor. That you don't need to have a Demat account, trading account, don't need to go through the stock exchange. It's available at any point of time. Just go to the fund house or to many of the online portals, buy the index.
What about liquidity, ease of redemption as well?
For index funds, there is complete ease of liquidity, right? You just go to the fund house,
And
take my
then,
redemption
yeah.
after T+2, T+3, whatever might be the cycle, money has come into your account. No concern.
But is that a problem with ETFs
in ETFs?
in India here, you
Sure,
would say?
in ETFs, and then taking on the point which Kaustubh mentioned, that for certain sector or certain segment of investors, let's say large institutional investors, who want to have access to that intraday type of a pricing, etc., definitely it's something which is beneficial. ETF as a structure is very effective tool, very powerful, no doubt. But for a lay retail investor who wants to build some kind of equity component into their overall portfolio for a long-term holding period, then definitely index is better.
Absolutely, take that point. Well, the big question I think from here on is going to be, what is the kind of return you're making if you're investing via passive funds or active funds, and what is the kind of cost that you have to incur? That analysis continues after the break. Welcome back. You're watching Money, 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 and this week we are talking active versus passive funds, particularly when it comes to the large cap part of your mutual fund portfolio. Is there a case to start thinking whether passive funds, ETFs, index funds, whether you should invest via them as well? So before we get down to comparing active versus passive, I just want to understand the cost component within the passive category. So whether it's ETFs or index funds, where will I have to pay less, essentially, as a retail investor?
Sure. So optically, one would think that ETFs you have to pay very less. For example, a NIFTY ETF is as low as about, let's say, 10 basis point as a TER, total expense ratio, as reported by the fund house managing that product.
Correct.
But how we'd like
as
to see
opposed to 2.5 to 2.25 for an active fund.
Actively managed fund.
Yeah.
But the index fund typically is much more lower than that. Let's say index fund typically in a direct plan would charge about 35 to 40 basis points. And now the ETF today, as per the TER reported, is let's say 7 basis point, 10 basis point. But how we like to see it, or how a retail investor should see it, as a TCO, total cost of ownership, that includes the brokerage, because you have to buy that ETF on the exchange compulsorily. So you have to go through your broker, pay the brokerage, depending on the arrangement with the broker. Of course, and let's say anywhere between 20 to 25 basis points you might pay while entering, means while purchasing that unit, and then subsequently while you sell it, again 25 basis points roughly, let's assume. So 50 basis point goes into your brokerage. Then you have to pay your demat charges, DP charges, etc., because mandatorily the ETF unit has to be held in a demat form. So that, and then add to that the 7 to 10 basis point of the TER. So roughly about, on an annualized basis, you would see, like, maybe depending on the time period of holding, but let 30-40 basis points cost comes up
for
over
an
there.
ETF.
For an ETF.
Yeah.
Likewise, on the index fund format, like you mentioned, we have recently launched a index fund. So there in the direct plan, we are charging about 40 basis points as annual cost.
And if it's a regular
plan? And it's a regular plan, it's roughly about 90 basis points, 90. Okay. So sub 1%, less than 1%.
Okay.
And very easy to differentiate that with the cost for the ETF.
Fair enough. So there you go. Now you have the cost structure between ETFs and index funds, and you can make your choice. And now let's get to the real touchy part of this, Kaustubh, which is, should I be paying 2.25% or 2.5% in some cases for an actively managed fund when I can track the index via these other passive funds at less than 1%. Now here I think some data and history will really help.
Sure.
What does the past performance really tell us? If you're talking about alpha generation, this outperformance concept, then is it really diminishing? Will it keep falling more? Is that what history and developed markets also tell us?
Sure. So there'll be a couple of things to this. So for starters, one is I think it's not a binary, either this or that.
Sure.
I think there is merit for both an investor's portfolio, but let me just start with, say, the actively managed. What we've seen traditionally in the Indian market, and let's take the context of large cap funds, which are the more popular, the widely held funds in India, we still see about half or slightly more than half the managers of the funds beating their benchmark. And we're talking about the total returns index here. So over the last 5, 7, 10 years, we've seen them beating the benchmark. You might have fluctuations in between on a yearly basis, but you're a long-term investor, you don't care about that. As long as over your investment horizon of at least 5, 7 years, your fund, your actively managed fund, which is already adjusted for your expenses, is beating the benchmark by 100, 150 basis points.
So wait, let me get this clear. You're saying that there's at least 150 basis points outperformance on at least 50% of the large cap funds available here in India over a time period of 5 years.
5 years. Yeah.
5 years or so.
That's right.
Okay, so I mean that's when perhaps it's going to make sense to pay that kind of a incremental expense ratio, the incremental fee.
Yeah, and we're talking about outperformance already adjusted for these expense ratios that we're talking about. So the outperformance is there post all those expenses, so it's fairly healthy. To the point that is it coming down? Yes, I mean what it was probably 10, 15 years ago was a lot more. I mean the market is kind of getting mature, and as more money comes in, that will see some shrinking, but we don't think it's going to go away in a hurry. And the classical case people talk about, US markets where it's passives that rule, and even Warren Buffett has come and said that it's passives the way to go. But I think India is still some time away from that, and we really think that the good active managers, come what may, will continue to do their job. So that's really from an active manager's perspective. And like we touched upon earlier, there is merit in looking at an element of passives in your portfolio also. And, be it a first-time investor who wants to use that as an entry tool to come into equities, or someone who wants to maybe use a particular sort of index, which may not be a broad-based index, but a slightly more savvy investor who would probably want to get a banking exposure or things like that. He could use an index rather than a fund on that. So there are elements where you can use ETFs even today. So you build sort of a core holding through actives, but also do not neglect. Do look at some passive investing in your portfolio, and I think it's only going to grow.
Okay, your thoughts on this as well, Anil? Same thing. This question of whether actively managed funds are actually giving me my money's worth.
I'll take the example what we did personally as a manufacturer. Sometime late of 2017, when we launched our first passive fund, like you highlighted, we clearly positioned it as a complementary product and not a competing product with an actively managed large cap fund. So how one can look to structure the portfolio in terms of like actual implementing this kind of strategy is that, let's say, some small component of your total allocation to equity, you put it to a core allocation into a passive fund at a low cost, etc., everything for a long term structurally, which you think you don't want to touch too much. And for the balance amount, try to select or try, let's say your advisor would highlight to you that these are 2 or 3 good large cap funds which you can invest, such that on an overall basis you have a small core element which is at a low cost, ensuring giving you equity market participation, and the satellite element of the active managers will be something which can give you the additional kicker of the outperformance over the benchmark.
Fair enough. So you obviously need both. It can't be just either or. That's the takeaway, very clear takeaway from this discussion. But we're not done yet. We'll take a break and come back and talk about really then what sort of product offerings are there in the market. What more can you expect this year as passive investing really picks up in India? The conversation continues on the other side. Welcome back. You're watching Money, 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 and this week it's the active versus passive debate on the show, particularly when it comes to large cap funds. So, well, our panelists have, established and have come to the conclusion that, of course, you need a bit of both. You can't just sort of ignore the actively managed funds entirely when it comes to the large cap side of the portfolio. Let me then ask you this, Kaustubh. How would you go about now allocating your money? So typically, I mean, the thumb rule that for a medium risk investor that, most fund managers or most rather investment advisors point is that at least if 50% of your money is going in large caps, then looking at the market conditions today and, the nature of product development, how much would you say can go safely into passive funds?
I would say since active management does exist right now, and it's not going to go in a hurry, I would build a larger part of the portfolio through active managed funds.
Okay. And this I'm talking specifically about large caps,
yeah, absolutely.
not mid caps and small caps. Yeah.
And that small portion, like Anil spoke about, it's kind of that fill it, forget it, shut it kind of portfolio that put 10-15% aside into a passively managed strategy where it's just tracking an index. You don't really need to worry about what's the fund manager doing, is there underperformance creeping in and things like that. It's tracking the index, and that's kind of your retirement money that you can just park away for decades, really. And the active managed portion, obviously you keep reviewing it to see if you want to make some style changes and things like that. But so a large part into active managed funds right now because there is alpha to be made, but keep some chunky 10-15% into passive and just let it grow.
Okay, that's good sort of tips and good thoughts to keep in mind. Anil, let me ask you now on passive, coming back to the primary subject there, where all can I invest? What kind of products are available now, and what do you think the market will offer as we go forward in the year?
As of now, in passive investments, bulk of it is fueled by equity products. Pretty much plain vanilla indices like NIFTY Sensex is where bulk of the investment is sitting. Slightly differentiated products, smart beta products like how we did a NIFTY equal weight that is there, or some other products are there. It's very small right now. But I feel going forward, that will be the main driver, in fact.
Okay.
That slightly differentiated products, smart beta products, but at the same time not very complex smart beta, black box type quant based products. Simple to understand, easy to understand. Don't keep it black box.
All right, fair enough. Any last thoughts, gentlemen? I mean, anything that perhaps investors need to be also a little wary of? There are things like tracking error that one speaks of, or any other issues with respect to liquidity, perhaps, if you are going the passive way. Kaustubh, final thoughts.
So I think liquidity is only going to improve. So as the market grows, liquidity will improve and tracking error hence will come down. They're already pretty marginal. The costs are, I would say, rationalized and pretty good. So as an investor, you have a choice between an active index or an ETF, and clearly, consult an advisor to understand. But you need to look at all of these elements rather than just going purely active.
Okay, fair enough. Final thoughts, Anil.
I think, as I mentioned earlier, the key for an investor to keep in mind is that as we move ahead and markets deepen further, definitely passive investing will become more and more important. And as an investor, one should really make sure it's there as a complementary strategy in your portfolio. Like you mentioned, Kaustubh, Warren Buffett, he mentioned for his wife's portfolio allocation, 90-10 rule. I'm not saying even 90% type of a thing, but I'm saying even if, of course, I leave each investor to be guided by their advisors in terms of exact percentage, but let's say if I talk about my allocation, every month some amount I allocate towards equity, from that 70% I'm allocating to a passive fund, 30% I'm allocating to two large cap actively managed funds.
The interesting thing is that I think many of us, without even realizing, are already passive investors. If you have an EPFO account, then part of that money is already going in the equity market via ETFs. And in fact, they're talking about a lot of changes as well, giving you more control over those ETF units. So those are perhaps some of the things that we will hear about as the year rolls on. Thank you, gentlemen, so much for joining in and giving us very valuable insights into the world of passive investing. Of course, what we've realized at the end of this conversation is that it doesn't have to be active versus passive. It can be active and passive as we mature as investors in the Indian equity market. Well, as we sign out, we are